Welcome to our latest Insider interview. Today in the studio I have with me Clive Beagles, who is fund manager of the Hambro UK Equity Income Fund. Clive, thanks for joining me today.
Great to be here.
So Clive, to kick off, could you give a brief summary of how the fund invests and how you differ from the competition?
Yeah, I guess there's a number of points of differentiation, but maybe just focusing on a couple to begin with. First of all, we invest across the whole of the market cap spectrum, so large cap, mid cap and small cap. So almost 50% of the fund is in mid and small cap stocks. So that means market capitalisations of less than, say, £4 billion in the UK. That's different to many other competitor funds in our sector that tend to be much higher up the market cap scale, focus on the larger companies. We think we can find more mispriced stocks amongst the mid and small cap arena. And secondly, I think again we tend to try and find significantly undervalued companies that happen to offer a superior dividend yield or some other valuation metric that we find attractive. Many of which might be at a relative low point in their own cycle, and so they have sort of recovery type characteristics. And whereas I think a number of other funds in our sector, fund managers behave a bit more like bond managers. They're almost just sort of looking for safe, steady, 4% dividend yields that they know are safe and secure, but actually where there won't be a great deal of upside from a capital point of view. So I think those are the things I'd call out the most as being different about what we do.
As you just mentioned, the fund has an emphasis on stocks that have higher yields than the wider market. So how do you judge a potential opportunity from a potential value trap?
Yeah, look, value traps are the hardest sort of things to avoid, I suppose, when you're particularly in the world of sort of recovery, turnaround. But again, at its simplest, value traps tend to occur where a company's making a certain amount of profitability today, but where there's a sort of permanent structural change going on in their industry that means in the future they won't make as much profitability. So I guess we're constantly on the lookout for structural change, maybe structural change that's being sort of underappreciated by markets and so forth. So best way maybe to think about that would be an example. You look at, say, quite a high-profile company like Diageo, okay, which is one of the largest sort of spirits companies in the world, big positions in whiskey, tequila. We think as a company, that company's been over-earning for a number of years. They've continued to push prices higher, ever higher and higher and higher. They got a bit carried away during COVID when people were at home and had nothing else to spend money on other than kind of not just on drink, but on things that, treating themselves at home in that regard. And we think prices have reached an unsustainable level, and actually they've lost market share to start-up brands or own brands and so forth. And at some point, we think there'll have to be quite a significant price reset, a margin reset. And the shares haven't performed very well. People keep asking us, why haven't you bought them yet? And to us, we still think it's a bit of a value trap. So that's the sort of you're never going to get them all those right. And sometimes, I guess the flip side of that, if you do own a stock and you become concerned about it, then take action rather than just sticking your head in the sand and just automatically doubling up just because the shares have gone down. Just constantly try and think about each company you own with a fresh set of eyes, fresh sheet of paper, and try and work out whether that investment thesis still is applicable.
And in terms of scrutinising the sustainability of a dividend, are there certain metrics such as dividend cover that you hold in a higher regard than others?
I think compared to others, we spend a lot more time looking at balance sheets. So we think people are a little bit lazy about balance sheets. So, a company might have high dividend cover, but it's got an awful lot of leverage. Then actually, if the earnings start to come under some degree of pressure, they might cut the dividend quicker than a company that, say, got net cash on the balance sheet, but actually the dividend cover might be lower, but actually it's got the financial wherewithal to maybe manage a short-term downturn in its earnings, for example. So we're much more, we only have 2 or 3 stocks that have net debt to EBITDA, which is the sort of metric people tend to look at for leverage of over 2 times. Diageo, we talked about just now, is a stock that's got much higher leverage than that. I think that's one of the reasons why those companies, that stock's been struggling. So, and almost 20% of the stocks in our fund actually have net cash on their balance sheet. They may have some cyclicality, but if they have cyclicality, we'd like to have a strong balance sheet to offset the risk of the not knowing quite how the cycle is going to play out.
And how do you try and get the balance right in terms of capital growth and income growth? As there can be occasions in which certain companies, they'll over-prioritise a dividend, and that can come at the expense of growing their business organically or using money to fund a potential acquisition?
Yeah, look, we want our companies to grow. We're not in the job of sort of beating our companies up and sort of demanding they give all of their available cash back to us every year, because that's a short-term kind of strategy. And that applies to whether we're talking about dividends or buybacks or the combination of both. So we want our companies to organically invest, to use part of their free cash flow to maybe make the odd bolt-on acquisition if it increases their sort of market share or position, and then just pay out a sensible but predictable level of dividend, which we think can grow through the cycle, even during time. Give yourself enough cushion so that if the cycle works against you for a year or two, you can still pay that dividend. And that is a balance. But if you have companies that grow, then you're going to have higher future dividends, in years to come, rather than just focusing on the here and now. So we're not interested, whilst our fund has a higher than average dividend yield, we're not necessarily particularly focused on the highest yielding names, because they may be ones that have got structural challenges ahead of them, or maybe are over distributing, or maybe have too much leverage for our appetite. So it's about trying to find a balance between all of those. But we really want our companies to grow. And if they grow, then we can have we'll have strong total return, including dividend delivered.
Could you perhaps give a couple of examples of stocks held in the fund today? Perhaps a stock that's more of a high yielder and one that's a lower yielder today, but is the dividend growth is potentially going to come through in future?
Yeah, okay. So look at the high yielding end. We have about a third of our fund is in financials. Obviously banks have done very well more recently, but actually within the financials area, an area that we've been adding exposure to in the last couple of years has been real estate, so real estate stocks. So I'd talk about a company called Hammerson, which is the largest owner of retail shopping centres in the UK. And if you went back 20 years ago, those were very popular. They were on there's the highest valuation and the lowest yield compared to other bits of property, say offices or industrial. Because of the emergence of sort of online shopping, and then the demise, which then led to the demise of department stores, the sort of about how's the phrase of Debenhams and these guys going out of business. They've had to replace an awful lot of tenants with new tenants. But actually today, the dominant, say, 15 largest shopping centres in the UK, and they own, for example, Brent Cross, they own the Bull Ring in Birmingham, they own West Quay in Southampton. So the really dominant out-of-town or indeed centre-of-town shopping centres. They're all beginning to see, they've seen football grow the last 2 or 3 years. They're seeing rental growth. They've got all of their centres are full. They're beginning to attract digitally native brands like Nespresso or Tesla or these kind of names who are almost using space in a large shopping centre as a showroom, rather than just thinking about making sales through that space. And yet the sector is still deeply out of favour. So we've got sort of the classic stuff we look for. Here's a sector out of favour, a company that used to be in the FTSE 100, hasn't been in the FTSE 100 for years. Many people thought it went bankrupt, which it didn't, by the way, but has sort of fallen off their radar, where actually the fundamentals are improving and the share price hasn't yet noticed. I mean, it's begun to pick up a little bit. So that will be a share that's yielding sort of 5.5%, but actually we think has good scope to grow, and we think the valuations will grow. Maybe at the lower ending, maybe sort of slightly lower yielding, and maybe a company, much lower yielding, but a company that everyone will have heard of would be Marks and Spencer. Okay, so Marks and Spencer is a company which I'd suggest got its mojo back 2 or 3 years ago. New chief executive, it's dramatically gained share in food. Its food market share has almost doubled over the last 5 or 6 years, which is interesting because it happened during a period of very high food price inflation, and most people would associate Marks and Spencer food with being at the quality, more expensive end, but they've almost gained share from people eating out less and treating themselves at home more with the higher quality food. But the dividend cover, they've been very miserly so far in terms of distributing their better profitability to shareholders, and they were probably just about to, and then they had their cyber incident, which could have set them back for 9 or 12 months. Result being that their dividend cover today is 8 times. Okay, now the average company in the UK, as you know, is about 2 times. So on the face of it, Marks and Spencer's is a share that only yields, say, 1.5%. But actually, if it moves to a sort of a sensible payout ratio or dividend cover of maybe 3 times, it could easily be paying a dividend twice as high as the current number, or even 3 times as higher, particularly because we think the earnings have potential to be meaningfully higher than what they're reporting today as they continue to grow share in food, improve their margins in their clothing and home business. So that's a share that I would say, looking out 4 or 5 years, is on a very healthy yield, and we would expect strong dividend growth over the next few years. And at some point, I think they'll make one other element they were worried about, they had a pension deficit, they wanted to pay that down. That's disappeared now. So their reasons for being cautious are sort of increasingly being knocked down. And I think now we're through the cyber incident, I'd expect that process to begin in the next 12 months or so.
You mentioned the fund invests across the UK market, companies of all sizes. Earlier this year, the average yield on a mid-cap company was actually higher than a company in the FTSE 100. And I think that's the first time that happens in around 20 years. Does that mean that you're finding more opportunities now in that area?
Yeah, I mentioned at the start that we're about 50% invested in mid and small cap and 50% in FTSE 100. That's the largest weighting we've had in mid and small cap since we started the fund 22 years ago. And why is that? For exactly the reasons you highlight. The valuations have become quite skewed. And actually, if you look at the valuation gap from a valuation premium that FTSE 100 stocks trade on to mid 250 stocks, it's higher than it was after the Brexit referendum, when there was an awful lot of economic uncertainty, and higher than it was at the worst point of COVID. So that seems quite extreme. Not everything is perfect in the UK economy. We've got some issues to work our way through. But actually, the situation is nowhere near as uncertain or indeed as dangerous as it was at those two periods. So that would suggest to us that if we keep looking in that 250 area, we're more likely to find significantly undervalued shares, and that's exactly what we've been trying to exploit.
BP is the top holding in the fund. It has been an eventful couple of weeks for the firm with the shock ousting of board chair Albert Manifold, who had been leading a cost-cutting and restructuring plan. What is your view on BP, and has it changed in light of recent events?
Yeah, no, it's been a very noisy period for BP, not just the last few weeks, to be honest. The last few years, if you remember, they had a period where they pivoted towards renewable energy, too much so really, and made some quite costly investments. They've pivoted back towards sort of traditional fossil fuels, and that has led to sort of some debate about what the right pace for doing that was, and they've had a couple of chief executive changes related to this sort of pivoting that we've seen. I'm not privy to exactly what happened in terms of the BP boardroom, but the observation I would make is the chairman briefly was an executive chairman because the company was without a CEO, and they have now got a CEO, and maybe he struggled to get back to a non-executive spot. I don't know. Anyway, all I do know is that the SID at BP is a lady called Amanda Blank, who I know very well because she's chief executive of Aviva. It's another share that we own, and if she felt it was right to move him on, then I'm happy to take her word for it. I'm sure in fullness of time, more details will emerge as to what was going on. Why do we like BP? Well, first of all, to say we don't own Shell, okay? So we're not overweight in oil, but we prefer BP over Shell. Why? Because it's under-earning relative to either to Shell or to its potential, because it's had lots of change. It invested all this capital in renewables. We haven't yet got the benefit of coming back to the more traditional part of the business. It's smaller, it's more nimble should be more nimble than Shell, because it's not the market cap isn't so big. So that, for example, differences can make a difference. And only last year they announced the largest new oil discovery in 25 years offshore Brazil, in a case called Bumerangue. And that should be able to those sorts of discoveries, having pivoted back towards exploration, over time should manifest themselves in a better operating performance, and their operating performance is below where it should be from a sort of a margin point of view. Their costs look elevated relative to their revenues and so forth. So there's quite a lot of change going through. We have got a new chief executive, a lady who's come from Australia, who I think this is her agenda, and I expect to see a significant improvement in the operating performance at BP. It seems to always attract an awful lot of media attention, and it's attracted even more than normal because of the events of recent years. But at its core, this is an under-earning business. One other point I would make is they still own 20% in a business called Rosneft, which of course is the largest oil company in Russia. They of course have not been able to do anything with that stake while Russia has been under sanctions. At some point, the war in Ukraine will probably end, and in which case they will have a 20% stake that might be worth 10 to 15% of their market cap that people have completely forgotten about. And that's just an extra degree of upside which people aren't even thinking about as we sit here today.
Financials is a key area of focus, and you mentioned that you have around a third of the fund in that sector. It's been a strong couple of years for certain areas of that sector, particularly the banks. So how are you now approaching investing in financials?
No, that's absolutely right. But particularly the banks. I mean, some of the banks, as you know, stocks like NatWest are up 4 or 5-fold from where they were 2 or 3 years ago. I think we have to remember that that starting period, many people viewed banks as uninvestable. Why did they think that? Because they were their view was very coloured by the previous decade. We've gone through 10, 12 years, ever since really the financial crisis and then COVID, where interest rates effectively were zero. And it's very hard for a bank to make a normal return when interest rates are zero, because you can't make a spread between what you're paying a depositor and what you're paying someone to borrow money off you. And it's only really been in the last 2 or 3 years that a cost of money has been re-established. We've now got a yield curve that looks something more like what resembles what we've seen in most of the last 100 years. And so really this phase has been about banks kind of getting back to normal levels of profitability. Now, so the question now is, are they over-earning or not? Some people would argue that they are, because, for example, the level of bad debts is very low today relative to their history. But that's because they've hardly done any new lending for the last 5 years. There's not much other than individual little areas like private credits. There's not much lending to go bad incrementally. So we don't think they're over-earning. So we've remained quite overweight banks, but what we have done is change the mix between our names, because 1 or 2 stocks have moved more aggressively than others. So NatWest had a very good move. We sold that about a year or so ago. We introduced a new bank, which is just about to enter the FTSE 100, actually, Investec. Why have we introduced Investec? Because the valuation of that bank looks like the UK banks did 2 years ago. And why is that? Because it's a weird company, because it's half listed in the UK and half listed in South Africa, and South African investors think it's a UK stock, and UK investors think it's a South African stock. So it almost feels like no one owns it, or even considers owning the share. So that's what we've done. We've rotated around, and then I mentioned earlier on the area of financials we've been adding to is real estate. It's a very different dynamic in terms of what's make real estate shares go up and down. Obviously, depending on they're very much more interest rate sensitive in terms of kind of bond, where the bond yield's moving, where interest rates are moving. But that would be the area that incrementally we've been introducing greater exposure within our broader financials bucket.
Clive, thank you for your time today.
Thank you.
So that's it for our latest Insider interview. For more videos in the series, do hit the like button and also the subscribe button. And hopefully I'll see you again next time.